Alright, as a continuity from the previous video, first one is the steps to determine the maximum mortgage loan level. Using the table 8.1 from the previous slide, determine your monthly mortgage payment with a 30 years old maturity with 8% of interest. That will give you your monthly payment times with 8%, that is 73.38, and divide the maximum monthly mortgage payment in line 1 by the monthly payment in steps 1. Multiply the amount with the amount of mortgage of 10,000. So 1350 divided by 73.878 times with 10,000. You have a maximum mortgage loan level of 183.974. But you do not have to worry about it. In Malaysia, the financier or the bank will do it for you and will tell you what is your maximum loan that you can get, what is your credit rating, and whether you are a riskier creditor or whether you are what risk level that you may want that you are able to take. Okay, so 80% of the appraised value of the house rules. This is another method. You pay 20% of the appraised value and you can borrow 80% of the appraised value of the house. Fund available for down payment and closing costs 56,000 minus closing cost 10,000 equals to fund available for the down payment, that is 20%. 20% equals to 46,000, so times 4 equals to 80%, so you have 184. This is a simpler method. Source of mortgage you can have from saving and lending institution or commercial banks, credit unions or mutual saving banks, mortgage banker, mortgage bank, originated mortgage loan, sales to bank, pension funds, insurance company and collect payment, or mortgage broker. These are the middleman comparison shop for the fee to secure mortgage loan for borrower but do not originate the loans. But in Malaysia, we can either go to the bank. You can also conventional and government-backed mortgage. These are conventional loans from a bank or saving and lending secured by a property. You can also have a government-backed loans. I think in Sabah we have this, I can't remember the name, but there's one in Karamun Singh. Okay, usually it offers lower interest rate, smaller down payment, less strict financial requirements, but then you have more paperwork, higher closing costs, and also limited funding. Fixed rates mortgage, monthly payment does not change regardless of market interest rate because the interest is fixed. You can lock in a low rates for the life of the loan, and assumable loan can be transferred to a new buyer, and prepayment privilege allows early cash payments to be applied to the principal. Then we have adjustable mortgage rate. Adjustable rate mortgage, interest rate of ARM fluctuates when the level of current interest rate with the level of current interest rate. Initial rate is the teaser rate, is usually low for only a short period of time, then adjusted upward. Interest rate index, rates on ARM are tied to the index, not controlled by the lender, such as 6 or 12 month US Treasury or Malaysian T-bills. Margin is the amount over the index rate that an ARM sets, and adjustable interval is how frequently the rate can be reset. So payment cap is a set dollar limit on how much the monthly payment can increase during any adjustable period. For example, if interest rate goes up, the monthly payment may be too small to cover the interest due, and it will be a negative amortization. So unpaid interest is added to the unpaid loan balance. It increases its size. So, and we also have ARM innovation. Over the years, several variations of the standard ARM have been introduced, which includes convertible ARM. It offers the borrower the options to convert the ARM loan to a fixed rate loan before a designated time, and they will usually have a nominal fee involved. Yeah. And also we have a reduction options ARM. It offers the borrower one-time opportunity to adjust the interest rates on the loan. These offers generally occurs in year 2 through year 6, and you choose if and when you will use it. And also another innovation is two-step ARM. These combine the aspect of fixed rate and adjustable rate mortgage. It starts off with a lower rate than the current market price fixed rate loan, and after a certain period, the interest rate changes and remain at the current rate for the life of the loan. So two most common type of two-step mortgage are the 5/25 and 7/23, which offers the lowest rate for the first 5 years or 7 years, and then adjusting the rate for the remaining 25 or 23 years. Okay, adjustable rate versus fixed rates mortgages. ARM usually offers interest rates, low interest rate in the early years, and it can get larger loan because of the principal interest tax and insurance is lower, and it can be reset. Interest rates push ARM payments upward. Fixed rate mortgages in general, fixed rate better than ARM. Payment never change. It allows for control and planning. Okay. Specialty mortgage loan options. You also have balloon payment mortgage loan. With a balloon payment mortgage loan, you make relatively small monthly payments for several years, generally 5 to 7 years, after which the loan comes due and you must pay off in one large payment. Exactly how large the initial payments are varies. In some cases, the initial mortgage payments are only large enough to cover the interest on the loan, and in other cases, the payment may be equivalent to the loan amortized over the value over 30 years. Yeah. However, what balloon payment mortgage loans all have in common is that payments are constant for a few years, then the loan comes due and it is paid off with a very large final payment. You also have a graduate payment mortgage. With a graduate payment mortgage, the payments are set in advance in such a way that they raise steadily for a specified period of time, generally 5 to 10 years, and then level off. Okay, sama after that. The selling point behind graduate payment mortgage is that the initial payments are relatively low, and so you are able to afford a house sooner. The assumption is that as your earning power increases over time, you'll be able to afford the raising payment. Okay. And we have a growing equity mortgages. A growing equity mortgages is designed to let the home buyer pay off the mortgage early, which is done by paying a little extra each year. It doesn't really help the cash-strapped buyer. Payment on the growing equity mortgage begin at the same level as the conventional 30 years fixed rate mortgage. Each year the payment increases, and this increase goes towards paying off the principal. Share appreciation mortgage. The borrowers receive a below market interest rate. In return, the lender receives a portion of future appreciation, usually between 30 to 50% in the value of the home. Thus, if you purchase a 100,000 home with a share appreciation mortgage that promised the lender 50% of any price appreciation, and 10 years later you sell the home for 180,000, the lender would receive half of that is 80,000 appreciation. So you pay low, but then you promise to pay them back after you sell the house. Then you have interest only mortgage. Interest only mortgage is a mortgage with interest only payment for the initial set period. For example, 5 years on the 30 years loan, and after this period the borrower pay interest and principal with payment adjusted upward to reflect full amortization over the remaining years of the loan. Then we have option payment ARM. With an option payment ARM mortgage, you have the option of making different types of mortgage payment each month. Your option might include an amount less than the interest due on loan, interest only on the loan, or the payment amount that would be required on a 15 to or 30 years fixed rate loan. So you have these options. Risk associated with a specialty mortgage is that big jump in monthly payment if interest rate rises. Read the fine lines. There are actually fees that they have in their agreements. Know how much your monthly payment could increase, when and whether you could afford them, and if you couldn't pay, they will impose penalties. Okay, beware of subprime mortgages. Mortgages taken out by borrowers with low credit score. We know that I think 10 years back we have this subprime crisis. These are the low credit scorers who actually borrow on a securitized mortgage loan, which is very dangerous. Predatory lenders take advantage of these lenders. Abusive loans, high cost loans with little chance of paying off, and avoid predatory loans with knowledge. So make sure you have an idea what you're getting on. So these are common predatory mortgage lending practices. Look at this, you read it. Okay, length of the loan, 15 or 30 years maturity on mortgage is actually decide on whether if you secure a 30 years mortgage with a prepayment privilege, you could easily paying it off in 15 years by making additional payments every month. Why not just take out a 15 years old if you're planning to pay off within 15 years anyway? Okay, this is the reason why. With a 30 years old loan, you wouldn't be locked in paying a high monthly rate of a 15 years loan. You have the flexibility of being able to skip making additional payments and pay much lower amount per month if emergency arose. So you take a longer loan, but then you pay additional every month. So you are not tied up to this shorter rate loan every month. Okay, so these are some of the things. Okay, if you can take a look at this portion of each payment that goes in the earlier years, it goes mostly on the interest rather than principal, and it uprise the principal value towards the end. This is the impact on loan term on the total interest paid monthly. Shorter terms would require a higher monthly payment and smaller interest. Longer term, 30 years, lower monthly payment but highest interest. So these are the differences when you compare short-term versus long-term loans. So you should be able to read this one. Alright, coming up with the down payment, save. How do you come up with a down payment? You can save from your saving. A gift from family or friends, you can save it. At least 5% of the closing cost has to come from the home buyer. And you also have a gift letter. Sometimes they give it as any fund contributed by relative don't have to be repaid. Okay, these are some things that your parents give you, your family give you. They give you ang pao lah probably. Okay, private mortgage insurance.